All right, well, welcome everyone. I'm excited you are participating either live or via a recording. We're going to talk about the importance of your credit score and why knowing credit score and how to improve your score can save you hundreds of dollars every month. After the webinar is over, you'll be able to receive a handout. There's a 3-minute evaluation, and then after that 3-minute evaluation, you'll receive the handout for this webinar. So again, thanks for being here, and let's get started. So what is a credit score? Credit score is a statistical number that depicts a person's credit worthiness. Lenders use a credit score to evaluate the probability that a person will repay his or her debts. It's a 3-credit number or a 3-digit number ranging from 300 to 850. The higher the score, the more financially trustworthy a person is considered to be. So you have different lenders and they're lending you money and they want to know how you've handled credit in the past and how likely it is that they're going to receive the money back from you that they lent to you and that you borrowed. So I do some financial and life coaching, and many clients ask about the difference between a credit score and a credit report. And as I just mentioned, a credit score is kind of like a financial GPA. It determines who qualifies for credit, at what interest rate, and what credit limits that you can get, how much you could borrow. A credit report, on the other hand, provides an analysis of how you have managed a variety of loans and then the probability of paying off those loans. It gives the detailed information about you and the accounts you have opened or closed, whether that be student loans or a mortgage or credit cards, personal loans, an auto loan, etc. So on the credit report, it gives all the details: when you opened them, when you closed them, how long they've been there, if you've had any late payments. And the credit score is this 3-digit number that kind of synthesizes it all down and makes it easy for people to understand and interpret what that is. What is not on your credit score? So there's certain things that won't be on your credit score due to discrimination and other reasons. You can see those on the screen, but it's not going to include your age or how much you earn, whether you're employed or not, if you're married. It's not going to tell you the interest rates on your credit cards or other loans that you have. It's not going to say whether you're paying or receiving child support or alimony. Also, there's these things called soft pulls. And so when you go to get a loan from a mortgage company or a bank or for auto loan, they're going to do what's called a hard pull on your credit, and that actually hurts your credit for a short amount of time because it shows that you are looking for and actively engaged in searching for more credit, which could be taking on more risk then. And so that's going to lower your credit score. A soft pull is when you pull it yourself, which I'm going to share later, how you can pull your credit report and your credit score for free. And those soft pulls do not hurt your credit report or your credit score at all. Also not on your credit score or credit report is whether you're having credit counseling or not. So let's look at the different ranges of the FICO score. And we're currently at FICO 8. They're looking to update that in the future to FICO 9, but right now we're on FICO 8. That's as of April 2015. And so here's the different ranges and the percentages that people fall into. So you can see here, well, according to the Wall Street Journal, in 2017, America hit the highest FICO score average ever of 700. So that's pretty good. We're actually improving in that way. But there is some high economic diversity in the U.S. The average credit score varies greatly among different populations, ages, income levels, etc. You could have great income but a low credit score, or low income and a high credit score. The lowest percentage that people range is in the 300 to 500 score, and the highest percentage that people score is in the 800 to 850. And so this is good news to see that there are a few people scoring badly and more people performing excellent. In this case, it's 19.9%. That's 800 to 850. And the highest score average in the nation is Minnesota with 702. The lowest average is Mississippi with 642. You may be asking, how do we do in New Mexico? And New Mexico is at 657 as of 2017. So that's slightly above Mississippi. I don't know the ranking, but we're probably one of the bottom three. All right, looking at credit score distribution by age, if you're looking at the webinar, you can see this chart that shows that the lower score is the dark blue, and then it goes up to the higher score, which would be kind of the pinkish purplish one. And the lower scores are higher for those who are younger, 30 or younger, 30 to 39. And you can see that as you go along and get older, the scores increase. And we may ask, why is it that as you get older, your credit's better? And is it just because your score improves with age, or you get better at working your credit, or what is it? And the reality is, one, since 2009 Card Act, it's significantly harder for 18 to 21-year-olds to open new credit card accounts without a parent's signature, etc., which is a good thing. As a result, though, many young adults don't begin building up their credit until later in life. Another thing is 15% of your credit score is based on your length of your credit history. So the longer your credit history, then the better it is. Also, 10% is a credit mix. And so as you get older, you're more likely to have a diverse array of loans, of a car loan and student loan and a mortgage loan and credit card loans, etc. And so the credit mix and the length of credit history is different for older adults, and that's why they have better credit on average. So how is your FICO score calculated? If it's your GPA, financial GPA, and you're wanting it to get as high as possible, how do we calculate this FICO score? The number one issue is payment history. That's 35% of your FICO score is based on, are you paying on time? And so you take big hits if you're ever 30-day late or 60-day late or 90-day late on your different loans. Some also ask, if I'm late on a credit card or a mortgage or something by a few days, yes, I get a late fee and then I pay it. Is that hurting my credit score? And the answer is not really, because it only hurts if they show that you've done a 30-day or 60-day or 90-day late. So as long as you're up to date and not being too late, then you're showing that you're having good payment history. 30%, the next biggest chunk, is the amount owed. And we're going to go into more details of each of these. 15% again is the length of your credit history, 10% is the credit mix, and then the other 10% is getting new credit. And you can see this and learn more about each of these by going to myfico.com, and it explains this in more detail. So why is it even important to have a good credit score? I mean, it's your financial GPA, and sure, they're more likely to maybe give you loans, etc. But I want you to ask yourself, do you know anyone on a tight budget? Do you know anyone who could use a few $100s extra per month? Would you like to pay less for your rent or for your mortgage or your auto loans or even different insurances or your utilities? Would you like to retire sooner and with more money in the bank? If so, believe it or not, your credit score has a huge influence on all of these areas. Having an excellent credit score is a huge benefit, and the higher your score, the less you pay. So we're going to show some examples of that and why that is so important here. Again, just to kind of give you an idea of what's excellent and what's not, we have this screen here that shows anywhere from 850 to 750 is going to be excellent. 700 to 749 is a good score. And I would actually say if you have 680 plus, that's where you want to be for most mortgage loans and auto loans and things. If you have 680 or more, then you're going to get some of the best loans. And then if you have 720 or higher, you get the very best, but you'll still get some great loans with 680. Then you have 650 to 699, that's a fair score. 560 to 649 is a bad score, and then anything below 560 is not where you want to be, right? That indicates to people that they don't want to do business with you. and it may take a while for you to improve your score so that you can have access to some of the loans and things that you want. So who is it that actually uses a credit score, and why should we care? If you look at this, there are different institutions that you will do business with that will require them to look at your score and to evaluate if you're worthy to do business with them. So a credit score can determine the rates and eligibility for nearly all types of prime loans. That'd be mortgage and auto loans, etc. Lenders will only give money to people who have shown the ability and willingness to pay the money back. Obviously, if you were going to loan money to a friend and they had a history of borrowing money and never paying it back, you would be less likely and not as interested in lending them money. And so it's the same thing. Scores can also be used to determine apartment costs and eligibility. So not all landlords do this, but some do. I know I have a couple of rentals and I look at their credit, and they require you to meet certain credit score before you can rent their house or rent their apartment. Auto insurance premiums have a huge impact on credit score, and I'm going to show you a slide of that later. Home insurance, life insurance, medical insurance, even utility companies, especially the big ones, look at your scores. And so if your score is poor, then they might charge you more. Many employers will not hire people with poor credit because they think that it's a factor in determining the type of employee they'll be and the commitment that they have and their ability to manage their own life. And so it's something they'll look at, and maybe you may not get hired due to your credit score. So let's look at a couple of examples. First one is auto insurance premiums. This is huge. And so on the left side of the screen, you can kind of see what hurts your premium for auto insurance. I'm going to walk through a couple of these, and also what helps your premium. And so in the white, you can see if you become a homeowner, if you increase your collision deductible from 500 to 1,000, if you bundle your home with your auto insurance, or if you get married, these all lower your auto premium each month. Now, the things that increase your premium, so you're paying a certain premium and then you have a moving violation. Well, it says it's going to add $225. You reduce your comprehensive deductible from 100 or 500 down to 0, which means that they have to cover everything. Well, your premium is going to go up. If you have a not at fault accident, some companies don't raise it, but others on average $270 it goes up per cycle, usually 6 months. If you have good credit versus excellent credit, it goes up 380. And then if you have 2 not at fault accidents, it goes up 465. If you have 2 moving violations, it's 470. 1 at fault accident, 500. You have a DWI, 775, it increases. You have 2 at fault accidents, $1,100 it goes up. Hopefully you're following along here on the left side of the screen. If you add a teenager, which I just recently did, it goes up $1,500 on average. If you have 2 DWIs, it goes up $1,750. And the worst thing of all of them, more than 2 DWIs or adding a teenager, is having poor credit. It raises it $2,090. So that's not good. If you have poor credit, that's the worst thing that's going to increase your auto insurance premium. And so you can see that if you had great credit, you could save a lot of money per month just by increasing or just by your auto insurance premium. Well, what about your mortgage? Let's look at that example. And so this is a $300,000 loan. This is a national average that we used. And so it shows the different breakdown of the FICO scores on the left side for a 30-year fixed mortgage, and then the APR that you might expect. And so the lowest right now, according to this, when we took the screenshot, was 5.7%. And then it increases all the way down to 10.19% for poor credit. And the difference in the monthly payment, the best credit only has to pay $1,746, where the worst credit for the same house, the same loan, the same amount, instead of $1,746, they're now paying $2,676. Guys, this is a difference of $930 a month, or $11,160 a year, just by having bad credit. And you can look down there and say, okay, well, if I had, $650, what would it be? Well, it'd be 2005 rather than 1746. That's $250 extra a month that you would have to pay. And so if you can see the auto insurance premium, that's the same with credit cards, it's the same with your mortgage, it's the same with any types of loans, it's going to be more expensive for you. In fact, they did a study that kind of took an average of all of these things we're talking about, auto insurance, the different loans, those types of things, and said on average, if we had two neighbors that lived right next door to each other, they had the same number of kids, the same number of cars, the same house and value of house, everything was the same, and one person had the ideal credit, let's say 760, and the other person had 580, they would be paying an extra $1,000 a month to live the same lifestyle as their neighbor just because they had bad credit. So again, if you want to raise without asking your boss, if you want more money in your pocket to pay off debt, if you want more money to invest for your retirement, you need to improve your credit. As your credit and score improves, you're saving $100, $300, $600, or $1,000 or more per month. So to break this down again, the ideal credit 760 or above, you're getting the best of everything. Loans, mortgage, etc., insurance premiums. And then if you're even 720, 720 is awesome, but you're still paying $100 more per month. 680 is $300 or more per month. 640 is $600 or more per month, and 580 or below, you're paying over $1,000. So that should hit home to many of you. And if you're trying to, again, get that raise or find more money in the month, start improving your credit score. So let's talk about some things that hurt your credit score. Again, I do some financial counseling, and a lot of people ask, hey, should I close my old accounts? Should I transfer all my money over to one credit card and cut up the other ones? What kind of things do I do? Let me share some things that will help your credit and some things that I get really annoyed at when people do that hurt your credit. So again, 15% of your credit is how long you have those accounts open. So some people say, well, I'm going to just close my credit card accounts. And what's wrong with that is usually a credit card account is one of the longest accounts that you have open on your credit. And if you say you have had that credit card for 9 years, and the next thing you have is maybe student loan or something else, and that's only 3 or 4 years, and you close that account and close that credit card, now your length of credit history goes from 9 years down to 4 years, and that's going to severely hurt your credit score because your length of time for your credit is now shortened. And so there's nuances to this, and you don't want to just blindly close your accounts without talking to a professional that knows what they're doing to help you. The next one, should you put all your credit card debt onto one card? Well, another one that we talked about, and we'll talk more about, is the credit amounts owed. That's 30% of your credit score is the amounts owed. And so the best is to have 30% or less of your available credit. So that means if you have a credit card that you have $1,000 limit on, you don't want to put more than $300 at any one time on that credit card because that's 30%. If you go over 30%, it's starting to hurt your credit because it's showing that, again, you don't have the discipline in things and you're maxing out the available credit to you rather than managing your life in a way that you can use it and you're using it as a tool, but you're not going overboard. And so 30% or lower of the available credit is what you should be using. So if you move all of your debt onto one card and max that out and then say cut up the other cards, now you've maybe lessened the amount of time that you have and your limit, you're maxed out, and that's hurting your credit as well. So you don't want to do that. Store cards. Should I get a store card to get a one-time 25 or 30% discount on my purchase? No. The short answer is do not do that. Another one of your the 10% makes up your credit score is your credit mix, and another one, 10%, is new credit. So you're going to get dinged two ways: new credit, signing up for a new store card, and two, your credit mix. They want to look at the type of credit you have, and some creditors are seen better than others. And so if you have a bank card or like a Citi card, a Discover card, things like that. That's gonna look good. That's from a major bank. But if you're going to be getting and you have multiple store cards, those cards aren't seen at the same level in lenders' eyes as regular, better credit cards from major banks. And so that's actually possibly hurting your score by the type of credit mix you have. And that's the same with this next one, using a payday lender. If you have a payday loan, and even though you're paying on time or even early and pay that off, that's still hurting your score because they're looking and saying, wow, this person needs a payday loan. And payday loans aren't seen well, and so that's hurting your score. It's the credit mix. So you don't want payday loans or any of those rent-to-own type things. You also want to stay away from signing up for new store cards, even though you get a one-time discount. Pick 2 or 3 credit cards that are good cards that are seen well, and then only use 30% of those, 30% of your available credit, and then pay them off every single month. It does not improve your credit by keeping a balance on your credit cards. And so I have about 3 or 4 cards from major banks. I use a couple of them for different reasons. I use them during the month. I'm usually 20% or lower on my balance, and then I pay those off every single month. And that's the way you want to do it. So what happens when you do max out your card, or you do have a 30-day late payment, or you do have a bankruptcy or foreclosure? You can see how big of a decline how big a hit you'll take from each of these actions. Now, what you'll notice, what this chart shows, if you're watching the webinar, is on the right side, you have a 780 FICO score, and in the middle, you have a 680. And you can see on the right side, if you max out your credit card, for example, you're going to lose 25 to 45 points versus only 10 to 30 from 680. So the higher your score, the harder you're going to get hit. And so it's hard to create a great score, but it's easier to get knocked off that pedestal and lower your score. And so again, for a bankruptcy, you're going to lose up to 240 points if you have 780, but only 150 points if you're at 680. And you can tell as you get hit with these point deductions from the previous discussions we've had in the slides, you're going to understand that that's going to raise everything in your life, and you're going to be paying hundreds of dollars more per month because you did one of these things on the left side. Maxed out your card, had a 30-day late payment, you had a debt settlement, you had a foreclosure, you had a bankruptcy. There's lots of different things that could happen. And so we want to make sure that these don't happen to you. And so we're going to talk about how to monitor your credit and make sure that you know what's going on and what's on your credit report, etc. So this is the percentages again, just to remind you, because we're going to now go into each of these in a little bit more detail. Again, 35% is based on your payment history, paying on time. 30% is the amount you owe. You want to stay 30% or lower. 15% is how long of a credit history you have, so don't close those larger accounts. Now you can cut the credit card up. You don't have to put any more money on it, but just don't close the account. Your credit mix, again, what type of credit do you have? Are they good ones, or are they the payday loans or the store cards that you're signing up for? And then new credit, as you sign up for new credit, it's going to hurt you because you have more of a risk because there's more available to you, but now your average credit length is going to shrink because this new credit has like 2 days on it. All right, so payment history. This shows the number of late payments, how recent your late payment was, how severe was your late payment. Was it a 30-day late? Was it a 60-day late? Was it a 90-day late? Again, how the age of your accounts. And so he's had this card for 10 years and this is the first time late, or has he had this card for 2 months and he's already late? And so you can see how that payment history goes into account. And then how many, the number of accounts that are currently past due, all of those go into this 35% payment history. And so the number one way to improve your credit is to pay on time, to not be late, and to just make your payments. Number two is the amount of debt, this 30%. And this is, again, the number of accounts that you have open, right? And so you can leave your longer accounts open. You don't have to close those. Some of those that are shorter, or even if they're bank card, not bank cards, but store cards, then some of those you might want to close. Again, the longer ones you want to keep open. This ratio of balance to credit limit to initial loan amount. So if you get a car loan and you get $12,000, do you still owe 11,000 on it, or are you down now to 6,000? And so the higher balance is going to hurt your credit score. The number of accounts with a balance. If you have 5 different accounts, but only 2 have a balance and they're under 30%, and you pay those off every month, that's going to look a lot better than 5 accounts maxed out. So how many of these accounts have a balance? Then your overall use of debt on all revolving accounts. Again, if you have 4 credit cards and they're all maxed out, or you're using them all the time and they're 80, 90%, then that's not going to look as good as having 4 credit cards, only using 1, keeping it below 30%, and paying it off every single month. Length of credit history, we talked a little bit about this. You want to keep those older accounts on your account. Don't cut. You can cut them up, but don't close them. You want to keep those open. And so it's the average age of the revolving and installment accounts. You got to take those. So again, if you apply for a new card, especially if it's a store card, it's the wrong kind of card. And then also now your average age has shrunk, and that's going to hurt your credit. Your credit mix, again, it's the type of lender. You want the good lenders. If you get a auto loan from your credit union or bank, that's going to look better than, say, even from the car. If it's a good dealership, but there's some dealerships that use kind of sketchy loans for those who have poor credit. That gives you the loan, but it's not the type of lender that the credit agencies and bureaus want to see. So it's this revolving line of credit and the installment loans and your mortgage and your student loans. You know, what's the mix of credit that you have? If you only have one and it's store cards, then that's gonna not give you as good a credit as having, say, a mortgage, student loans, car loan, credit card, etc. There's a nice mix, and you can show that even in revolving credit or installment loans, you can pay on time and pay those off. Then finally, new credit. Again, how many did you open within the last 12 months? How many of hard inquiries have you received recently? And then especially in the last 6 months, what are the recent loans that you actually got? And so let me just talk real quick about, again, hard pulls. If you're going to go for a mortgage or to get an auto loan, they only count, you can go and they expect you to go out and kind of compare different rates, right? So if you're going to look for a mortgage loan, let's say you're going to refinance, I would recommend getting one from, say, if you're with a credit union or a small bank, looking at a larger bank, and then going to a mortgage company, because they have lots of different types of loans that might be beneficial. So then you get 3 different people pulling your credit in order to get an accurate estimate or quote of what that might look like. That only counts as one hard pull. So even if you had 4 or 5 people pulling your credit for the same reason, looking to refinance your mortgage, it only counts as one. Same thing with an auto loan. If you're going and you go to multiple different places and have 4 or 5 places pull your credit in order to give you a quote for what your auto loan would be, it only counts as one, because the economy understands that you're comparing and looking for the best rate for an auto loan. And so that only counts as one. Now, if you go and you get an auto loan, pull your credit for an auto loan, pull your credit for a mortgage, pull your credit for a cell phone, those are going to be 3 different ones, right? It's only for the same category that you're comparison shopping for. All right, so igniting your score. How do we ignite the credit score? Because we want to go up, up, up on our credit score, and we don't want to have a low score. So what are the things that improve our credit score the most? Well, again, number 1 on the top left here is to make all payments on time. That's the number 1 factor. You also want to make more than the minimum payment or pay off your credit cards. And so it's showing that, yeah, he only has to pay $35, but he's paying $50. And so that shows to lenders that this person has extra income. They're not strapped. They're not, paycheck to paycheck. You want to keep your loan balances low. Again, 30% or under is what you want to be at. You want to keep your older accounts open so that length of credit history is there. You want to limit the number of credit cards you have. So again, if you have multiple credit cards and some of those are store cards, I would look at the 2 longest standing cards that you have, and maybe there's a great bank card that you have that you use all the time, and then there's other ones that are kind of not as long, or they're store cards, and you might want to close those cards. Then you don't want to open any unnecessary revolving credit accounts. So no new things, especially store cards. Just keep and use what you have, and you can see how much it costs you per month by lowering your score and having a bad score. So saving on $80 at the store and saving 25%, which is $20, is going to hurt you more even that month, possibly that month, but definitely over the next few months and years, in your credit score and how much more things are going to cost you, then you're going to save with that one-time 25 to 35% discount. So please, again, I've been harping on this, but don't open store cards just to get a discount that one time. So good credit score equals lower premium. So what do you want to do? You want to be reviewing your credit report. You want to keep your credit lines open. Again, maybe there's some you can close. Again, those store cards, especially if you just recently opened those. You want to pay down debt. You want to reduce the hard credit pulls. You want to pay bills on time. You want to do all these different things. And so this is kind of a nice graphic here that shows that what a high achiever does and what the improver is trying to do. And on the left side, the high achievers, 96% of them have no late payments, none. On average, they only use 7% of their credit limit. So remember, I said 30% or lower, they're only using 7% on average. They owe less than $3,500 total on all credit cards, and their credit history length on average is 25 years. So you can see how those play into effect to raise your score to the 800 versus if you have less of, not as long of a length of credit history, or if you have more money on your cards, or you're using more than 30% of your credit limit, or if you have some late payments, those are things that are going to ding you and hurt your credit score. Okay, now let's talk about how do you get your credit score? How do you get your credit report? How do you figure out what's going on and monitoring it? Because another thing that's happening a lot is with all of these breaches from Equifax to Target to others, a lot of our information, personal information, is out there, and you don't want to be, you don't want to have your identity stolen. And so we're going to talk about how to keep that from happening. So you want to obtain a free credit report at least once a year. Another thing you could do is, because you get a free credit report from each of your 3 credit bureaus. And so just to show you the 3 credit bureaus, that's Equifax, Experian, and TransUnion. And so what you could do is you could get a credit report from all 3 of them once a year, or you could kind of spread those out, and every 4 months you could pull one. And that way, every 4 months, the year is up for the next one. And so some people put those on their calendar, just say, pull my credit report. They do creative things like pull it on 2/2, 6/6, and 10/10, and that's kind of 4 months apart to help them remember. But you definitely want to think about and pull your free credit report. If you've never done it, I recommend pulling all 3 and seeing what's on there, because there are some variations between them. And then after that, next year, you can start pulling it once every 4 months. Now, the best place and the only place really to get your free credit report that shows everything on there is annualcreditreport.com. You can see that on the top of the screen. There's annualcreditreport.com. You go there, put in your information. It asks you if you want to be pulling your credit from Equifax or Experian or TransUnion or all 3. It's going to ask you some questions in order to determine that you're you, and ask you about, in the past 8 years, which of these cars have you owned? And it's going to put up different cars and stuff like that. Which of these addresses is not one that you've lived at in the last 10 years? And so it goes back quite far, and sometimes it strains our memory on some of those. But if for some reason that doesn't work, then you can always go to the number there, 1-877-322-8228. You can also mail the annual credit report request form that's shown on the screen there as well. So some examples. There's different types of credit scores. FICO score 8. FICO 8 is the one that lenders use. And then there's other ones like the Vantage 3.0. You can see here in the middle, Credit Karma uses Vantage 3.0. And so that's going to be a little different than the FICO 8 score. But I'll talk about this in a little bit, but you do want to sign up for a credit monitoring, free credit monitoring service, and Credit Karma is a good one, as well as Credit Sesame. I use Credit Karma. So you can see kind of, this is just to show that there are different examples. This American Express, which uses FICO score 8, has 816, but that's based on Experian, and then based on TransUnion for Discover, it shows 791. And so there's just going to be some different types of things. You can see also the bottom one, Barclay card, it's 791 based on TransUnion using FICO 8, which is the same as Discover card. So between Experian, TransUnion, and Equifax, they're going to have some different numbers. And usually what a lender does is they do a pull all three bureaus. It's called a tri-bureau pull, and they'll take the middle score. And so if you have 816, 795, and 780, then they're going to use the 795 for your loan. And then Vantage 3.0 is going to be a little different, but at least it gives you some idea of the ballpark of where you are. So here's an example. This one is mine that I just pulled recently from Credit Karma. So you can see up on the top right, you can click between the Vantage 3.0 score, which is again what Credit Karma uses, between TransUnion and Equifax, and it shows you a difference in what those points are. And also you can see that's highlighted in blue under the 778, it says credit factors, and those are below. How many hard inquiries have I had? How many total accounts do I have open? What's my average credit age? I've had things open longer than 9 years, but on average, that's what it shows. Do I have any derogatory marks? What percentage am I using on my credit cards? And am I late? What's my payment history? So you can see those are all green, which means good. If they turn yellow, that means that's not as good. And red, it means you're not doing great at all. Then if you click over next to, you see the blue line that with credit factors, if you click on the credit report, the nice thing about Credit Karma is that it goes through and it shows you some of the things on your credit report as well. And so I sign up for notifications with Credit Karma, as well as through TurboTax, as a couple different ones. But you can do this with Credit Karma. And if your score goes up or down, or there's a new inquiry or something like that, it alerts you. It sends you an email, and you can get on and say, see, hey, was that me, or is that somebody else trying to steal my identity and open credit in my name without me knowing? So I strongly recommend getting signing up for something like Credit Karma or Credit Sesame or whatever that monitors your credit. And it does this for free. So you don't need to sign up for a credit monitoring that costs money. Do it for free and be alerted when different things happen. It's very, very useful. Another one is creditscorecard.com, and this is through Discover Card. They'll encourage you to sign up for a card, but you don't have to. So don't sign up for the card, just register, get this. And the reason why you want to do this is because this gives you your FICO 8 score, which is what the lenders use. Where again, Credit Karma up here uses the Vantage 3.0, which again is in the ballpark, but it's a little lower than your credit score. So you can see mine 778 here with the Vantage 3.0, but then when you go to your FICO 8, again, this is mine, I'm now at 816. And so there is some difference in those. And so again, it's green, it shows you what's helping, what's hurting, it gives you a list. It's really nice. And again, this is free, creditscorecard.com, and you can go through and look at what's hurting and helping your score, and it gives you ideas of how to help and improve your credit. So how do I repair my credit if it's bad? What kind of things do? I get on there and I pull my free credit report. I signed up for Credit Karma, and I'm looking on my report, and some things on here that are supposed to be on here. Yeah, I was late, and that's fine, but what is this judgment against me? And I don't know what that is, and that shouldn't be on there. Or something's in collections and I don't have a clue what that is. So if that's true, then that's hurting your credit report. If there's something on there that's not supposed to be there, you don't want it there because it's lowering your score, And as we know, your lower score means everything costs more money. You're paying more for your auto insurance premiums and your homeowner's insurance premiums and your credit card interest rates, and everything else is costing you more because your credit is lower, and your credit's lower because somebody has a judgment or a lien or something on here that's not yours. So it's critical to pull your credit report. Again, you can go to annualcreditreport.com to get it. You can also get on Credit Karma and sign up for free and look at what's on there. And when you find something on there, again, if it's true and you were late, you can't legally remove that information from your credit report, right? There is no quick fix to fix your credit if you were wrong. But if there's errors on your credit report, then yes, you can ask for an investigation. You go to the bureau that has it. Again, that's why if you pull the 3 credit bureaus, Equifax, TransUnion, and Experian, you can see if there's anything on any of those 3 credit bureaus that's not yours. And if there is, you contact them and say, hey, this is inaccurate. And they'll ask you for some, if you have any type of records that show that you paid that off or that's not yours, and you dispute that item. There's a lot of places that you can go to get sample letters, etc., that shows what you could send to them to get that away. But one of the best places is the CFPB, which is the Consumer Financial Protection Bureau. You go to consumerfinance.gov and then just search credit, and then a screen pops up that shows at the bottom here all of these issues. Understanding your credit reports and scores, getting a credit report, what affects your credit, building a credit record. But that bottom one on the left, disputing errors on a credit report, you want to click on that, and it's going to give you step by step how to take care of that and what to do, and give you an example letter if you need to, in forms and stuff like that. They're making it easier so you can do a lot of this now online. Again, I had something that came up on Credit Karma and on my Discover card. I have a Discover card, so I have the creditscorecard.com, and they came up on both. And it asked me, do you want to dispute this? And so I just did it right there in Credit Karma and said, I want to dispute this, and sent it to them, and did it through there. So online, it's very easy. Also, if you go to myfico.com, then there's multiple different areas as well, and it's going to have a little link that talks about disputing errors on your report, and they have some fantastic resources as well on how to fix your credit score. So definitely want to check your score. You want to sign up for a monitoring service, and then there's easy ways to get things off of your credit report if it's not supposed to be there. All right. So there's a breach, right, back with Equifax, 2018. There's been breaches in other areas. Our personal information is out there, and so a lot of people are, a lot of experts are recommending that consumers freeze their credit. And in mid-2018, Congress actually made credit freezes free. It used to cost money to freeze, and then you have to unfreeze or thaw your credit in order to apply for something else. So if you want to go and get a loan for a car, or if you're going to get a new cell phone and they have to check your credit or whatever, and your credit is frozen, then they won't be able to check your credit. And so in order to allow them access, you would have to unfreeze your credit report. So before, it was kind of a nuisance because you'd freeze it and have to then unfreeze it, and it would cost you money. But because of the big breaches and things, Congress passed a law that says now it's free to freeze and unfreeze your credit, and that's a good thing. It does still take time, but freezing your credit is a good thing, because then it keeps you from, if you're at the store again and they're like, hey, get a store card and get 25%, you're like, okay, and then they try to check your credit and they can't, that might keep you from getting that store card. So again, some experts recommend that we freeze our credit, and this will reduce the risk of, again, identity theft and being a victim. But you got to keep in mind that freezing your credit, it does have to be done individually with each of the reporting agencies. So with Equifax, with Experian, with TransUnion, you go to their website and just type in, say, TransUnion freeze credit, and it will come up and give you a link. But by freezing your credit, you can prevent potential creditors from accessing your credit file, thereby preventing identity thieves from opening accounts in your name. However, it will not deter non-credit related frauds, so such as tax identity theft, health insurance fraud, etc., or from making changes to your existing accounts. So credit freezes can be made online or by phone or by mail. It will take a little bit of time to do this, but I recommend first to sign up for a free credit monitoring service like Credit Karma or Credit Sesame, and then freeze your credit. Because if you freeze your credit and then try to sign up, then they can't access your credit either. So we want to be monitoring our credit. So you want to get online today or next day or two, sign up for one of these free services. Again, Credit Karma, Credit Sesame, creditscorecard.com. And then after you do that, you can get on and freeze your credit, which limits anybody from accessing your credit and reduces your probability of becoming an identity theft victim. It also then allows you to verify that no one's opening accounts in your name because you're monitoring your credit. And then other people have asked me, what about my kids? Can I freeze my kids' credit? And do I even need to? A lot of people don't think about that. The Identity Theft Resource Center says that kids are 51 times more likely to be the subject, not twice as many, like not double or triple, but 51 times more likely to be the subject of identity theft than adults. Another study that someone else did found that 1 in 10 kids has his or her identity stolen by the age of 18. So if you're wondering, hey, I teach students and high schoolers and things about this, a lot of times they're like, well, I don't have any credit. Why do I need to pull it or worry about it? It's because identity thieves know that you're not pulling it, and so they're trying to get access to your information and opening accounts in their name without them knowing, because they're not worried about their credit because they're not even 18. So according to the FTC, which is the Federal Trade Commission, some warning signs that your child's identity has been stolen include the following. 1, being turned down for government benefits because the benefits are being paid to another account using your child's social security number. Number 2, getting a notice from the IRS saying the child didn't pay their income taxes, or that the child's social security number was used on another income tax return. Number 3, getting collection calls or bills for products or services you didn't receive. So luckily, you can most likely avoid those 3 scenarios by freezing your child's credit, which again is also free. So you'd have to contact the 3 bureaus to freeze your child's account. Another question I often get is, what about just setting a fraud alert, right, instead of freezing your credit? What this does is it requires creditors to verify your identity before issuing a credit card, opening a new account, or increasing a credit limit on an existing account. So a fraud alert will not prevent a lender from opening credit in your name the same way a freeze does, but it does require a lender to take additional steps to verify your identity first. And so they'd kind of like if, I have Citibank and I try to use it somewhere that I typically don't, and they block it, and I get a text and a call that says, did you try to make this purchase? And if I say yes, then they say, okay, your credit card is unfrozen, you can use it now, right? And so putting a fraud alert on your account will allow, not allow, but requires the creditor to verify your identity before issuing something new. So again, just to sum up on this part, I recommend signing up for a free monitoring service and then doing a credit freeze on yourself and on your children if you have them. If you are looking to get a loan soon, then obviously you don't want to do that. Just sign up for the free credit monitoring. You want to also pull your free credit reports and look at those. If there's things that need to be removed, you start doing the process of removing those. And after you get your new loan or whatever it is that you needed to do, I'd recommend getting on and freezing your credit. So hopefully you learned today some ways to improve your credit, what hurts your credit, what improves your credit. You've learned why credit is so important, that it can save you hundreds, if not even over $1,000 a month by improving your credit and having good credit. If you want to raise, if you're living paycheck to paycheck, if you want more money in your pocket, if you want more money to invest, to save for the future, more money to pay off debt, etc., improving your credit is key. And we've talked about how to monitor your credit, where to pull free credit reports, how to get your free credit score, both Vantage 3.0 and FICO 8 scores, and then how to put a freeze on your credit so that other people, you're not a victim of identity theft, including for your children. If you have any questions about this, please send me an email. It's brycej@nmsu.edu. I'd be happy to talk to you and help you with your credit. Again, after this concludes, you'll have a 3-minute evaluation. Please do that, and then you will receive the handout for this presentation. I appreciate your help. Thank you.